Understanding the spread. In this video, we are going to go over what is a spread and the key factors of the bid and ask spread. So let's get started. What is a spread? So the spread is the difference between the bid and ask price. So you guys have probably seen this by now. There's two sides when there are orders going through. There's the bid side and there is the ask side. Now on the bid side, this is where people are looking to buy. And everyone should be very familiar with this by now. And then we have the ask side. The ask side represents the level where people are looking to sell. We have the bid and we have the ask. The spread is the difference between the bid and the ask point. So in this situation, the bid is $4.25, the ask is $4.55. So the spread is 30 cents. Now, if the bid was at $4.25 and the ask was at $5.25, then the spread would be $1. Now, understanding the spread is very, very important. Now, the reason it's important is because when you're trading, you need to know the stock you're trading, the option contract you're trading, whatever you may be trading, you need to understand how high or how tight the spread is. Now, there are certain times the spread gets very, very wide, like the bid might be at $4.20, the ask might be at $4.80. Now, that's when the spread gets very wide. Now, there's other times where the spread is very tight. The buying point might be at $4.20, the selling point might be at $4.24, right? So now there's only a 4-cent spread, which is a pretty tight spread. So knowing how tight or wide a spread is extremely important for you as a trader. Regardless if you're trading an option, regardless if you're trading stocks, whatever you're trading, you need to understand what the spread is. Now, this could be found on level 2, and everyone should be familiar with this by now. So if you did the action items in part 3, part 4, part 5, and you went through charts and you saw level 2 and you looked at price action, you should have seen this by now and be very, very familiar. If you're not familiar, you should go back and check it out. Now, the next thing, the reason this is important is because if I have a spread of 30 cents on a stock, and let's say right now I want to buy, for argument's sake, I want to buy 100 shares. I want to buy 100 shares at market order. I'm going to pay $4.55 plus more maybe. That's because that's where the sellers are looking to sell. So if the sellers are looking to sell at $4.55 and I want to buy 100 shares at market order, I'm going to pay $4.55 or maybe even more because I'm using a market order, right? So understanding the spread, once again, is important because you want to know where the buyers and sellers are and how wide or how tight the spread is. Now, a few key factors about the spread before I show you a few more examples. The bid-ask spread can be impacted by a range of factors such as liquidity. So liquidity affects the bid and ask spread. So liquidity, this basically refers to how easily a security, and once again, whenever I mention the security, I mean anything such as a stock or an option, can be bought or sold. As liquidity increases, the bid and ask spread usually tightens. And as liquidity dries up, the bid and ask spread usually gets wider. So if you're trading a stock that has a lot of liquidity, the bid and ask spread will most likely be very, very tight because there's a lot of potential buyers and there's a lot of potential sellers. Now, when there's not a lot of potential buyers, when there's not a lot of potential sellers, the bid and ask spread is probably going to get wider and wider and wider. And you have to be careful with that with certain stocks because if a stock does not, once again, have a lot of liquidity, it doesn't have a lot of volume being traded, there's a high possibility that there's an extremely high spread. Now, this is something that you guys should always remember, especially when you're trading options. For options, when you're trading option contracts, there's usually a high spread on a lot of option contracts because there's not a lot of liquidity within the options, within the contracts. So when you're especially trading options, make sure you understand what the spread is because sometimes with calls or puts or any option contract you're trading, the spread is probably the buying side is at 235, the ask side is sometimes at, let's say, 265. So there ends up being a huge spread, And seeing about a 30-cent spread on a $2 stock or $2 contract is a lot. Now, if this was a $200 stock, 30 cents wouldn't matter. It wouldn't be a lot. But for something that's valued at $2.35, 30 cents is a lot. Okay, so the first thing that affects the bid and ask spread is liquidity. Next, we have volume. So volume showcases the total amount of quantity traded. Securities that have a higher trading volume will often have a tighter bid-offer spread, and securities with low volume will often have wider bid-offer spreads. So once again, if there's a lot of volume, there's somewhat a possibility that the spread will be tighter. Now, if volume is low or volume is decreasing, or there isn't a lot of volume in a stock or an option or whatever security you're trading, there's most likely going to be a wider spread. So these are things you have to kind of understand. And then last, volatility. Volatility basically is a measure of how much the market price changes in a given period. During periods of high volatility, when prices change rapidly, the spread is usually much wider. Because of those crazy volatile moves, the bid and the ask usually get very, very spread out. And they also get very spread out because think about it. If the bid is at 410, right, and let's say the ask is at 525, if someone sells market, the stock goes to 410. If someone buys market, it goes to 510, 410, 510, right? So that's causing huge movements on the up or down side, and that's happening because the bid and ask spread are either too wide, and them being too wide are causing massive volatility. They're causing massive price shifts in the stock or option or whatever security you're trading. All right, so right here, we're looking at stock Apple. So if you guys can see, we're looking at the level 2 of stock Apple. So here we got the bid, and right here we have the ask. Now, if you take a look at this, you'll see that the spread here is pretty tight. There's probably a 1 cent spread. Not probably, there is a 1 cent spread. You guys can see it on the bid and the ask. There's legitimately a very, 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 very small spread. Now, the reason for this is because Apple is a very, very tradable stock. Like there's a lot of volume. There's a lot of liquidity with the stock. With that being said, that's why the spread is very, very tight. Now, if Apple did not have a lot of liquidity or did not have a lot of volume, the spread would most likely be very, very wide. Now, I don't have to go into looking at the liquidity and all that stuff. I can just see the level 2 and say, wow, the spread itself is telling me that this stock has a lot of liquidity. And then when I go look at the volume, I'll see Apple trades in millions and millions of shares a day, which is showing me that there's a lot of liquidity and there's a lot of volume present in this stock. All right, so now we're going to look at stock MITO. So if you guys take a look at the bid and you guys take a look at the ask, you can see there's a 30-cent spread on this stock. Now, a 30-cent spread on a stock that's $6 is very different from a stock that's trading at $200. So if Apple had a spread of 30 cents, that wouldn't be a lot. But if you take the same 30 cents and you apply it to a stock that's trading at $6 or $5 or $4, there's a big difference in that because those 30 cents add up and end up being a lot of money for a smaller, for a stock that's valued at a smaller number, right? So that's one thing I want you guys to understand. A lot of people tend to confuse that. They ask, what's a high spread? What's a low spread? It first starts with what stock you're looking at. So looking at a $6 stock, once again, a 30-cent spread is going to be much higher than obviously looking at a $200 stock. Now, moving forward and understanding, once again, 30-cent spread here, that's kind of high. Now, that's not massive, but me seeing a spread like this, I'm not really a fan of kind of trading stocks like this. They usually have low volume. Their volume is under 500,000 shares traded per day. So I'm not really a fan of trading that at all. So right here, this is a clear example of a stock that maybe doesn't have a high liquidity, probably doesn't have a lot of volume traded, right? Now, with that being said, the next thing you guys have to understand is a lot of times, like I mentioned, this right here, the bid and the ask, the people that are sitting at the bid and the people sitting at the ask are usually market makers. So market makers are sitting here and their job, once again, is to kind of fill the bid, fill the ask, and exchange shares. So if you ever need to buy or sell a stock immediately at market price, their job is to make sure those orders get filled. Now, what a lot of people don't understand is when they tend to open up a stock chart, they look at a chart and they're like, wow, this chart looks amazing. They don't really understand the spread. Since they don't understand the spread, what happens is that person might say, hey, I want to buy 1,000 shares at market. Now, since you want to buy 1,000 shares at market, what's going to happen, or what typically should happen, is you're going to try to hit the ask price, or the system is going to hit the ask price. Now, once the system hits the ask price, you're going to get it for 675, 679, 680, and a little bit at 691 until you get your 1,000 shares. Remember, this right here each number represents is equivalent to 100. So this is 500. This is 100, right? 100. This is 1,000, right? This is all explained in the level 2 video. If you guys went through it, you should be familiar with it by now. Now, if I'm buying 1,000 shares at market, I get 500, 600, 700, and 300 from here. So what typically happens is I'm paying a much higher price. Now, since this is market makers, and you guys are going to see this happen a lot, which is what I'm trying to get to and explain, so you have a very good understanding, is even if you're looking at the stock, you might say, okay, fine, I want to buy 1,000 shares. I don't care about getting 1,000 shares at 675. It's cool. I don't care. I think it's going to go up. But now what you don't understand is if this is market makers sitting at 675 and you process a market order, sometimes market makers take their ask off, take their ask off, take their ask off. Now what happens is when your order gets filled, you end up getting 1,000 shares for $6.91, right? So that's because market makers are quickly taking their shares off the table. You're probably like, okay, I'm going to get 1,000 shares. I'm going to get a few hundred at 675, a few hundred at 679. No. A lot of times, if it's market makers, they pull their ask or bid off the table and you end up paying a much higher price. So that's one thing. When you see a high spread, always, 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 always use a limit order. If you want to trade this, use a limit order. That's number one. If you see a stock, an option, anything with a high spread, do not use a market order. Use a limit order, guys. Make sure you execute on a limit order. Now, when I see a high spread like this, a lot of times you can hit the mid price, like a middle price in between. Let's say I put in an order to buy 1,000 shares at 660. There's a possibility I might get filled. If it's market makers, they might fill me at 660. So now, when I'm trading this and I'm using a limit order, if I look to buy 1,000 shares at 660, there's somewhat of a possibility I might get filled. Me knowing that, I'm already saving 15 cents per share by understanding just that concept. So it's super important to understand how this whole order flow system works. If you don't remember it or don't understand it, go back to the beginning where I talk about market makers. Go back to the beginning where I talk about different order types, market orders, limit orders, just so you have a strong understanding and you can connect the dots. Now, moving forward, let's look at another trade. So right here, we're looking at the bid and ask spread for Amazon options. You can see it's very similar, right? But now this is for an option contract, right? So this is for a call. Right? Call, once again, means that the stock is you're anticipating that the stock is going to go up. Now, same thing in this situation. If let's just say I want to buy 2 contracts. If I want to buy 2 contracts right now, I can pay the ask. I can say, you know what? Put in a limit order to buy 2 contracts at 12.40. I'll get filled. Now, another thing I can do, depending on how I'm trading, I can say, you know what? Let me try for 12.30. Now, if I try for 12.30, which at times is kind of the mid price or the midpoint between the bid and the ask, I might get filled. Now, if you look at here, the last price that the stock traded at was for $12.30. Now, the bid and the ask were probably the same, not saying they were or weren't, but it was probably the same, meaning that someone got filled at 12.30. Now, what a lot of people do wrong is they're like, okay, I want to buy 5 contracts. I'm going to use market order. Now, once again, once you do that, market makers can move the 12.40s off the table, and now you're getting filled at 12.45 and even maybe 12.70, right? So you have to be careful with using market orders on any sort of stock or option that does not have a lot of liquidity. And especially when you guys are trading options, please be careful because a lot of option contracts do not have volume and they do not have liquidity. So do not put yourself in a tough situation. Now, moving forward, one more example. We are looking at Apple options, the bid-ask spread of Apple options. Now, if you look at this, you'll see there's a little bit more size. If you look at Apple's options for this contract, you'll see there's a lot more size. There's a lot more volume. There's a lot more liquidity. And with that being said, you can see the spread, 3 cents. There's a small spread. Now, this also goes with how many contracts or how many shares you're trading. Now, in this situation, if I'm trading 500 contracts, I'm not going to use a market order and buy 500 contracts because I'm going to probably end up paying a very, very high price. Now, at that point, I would obviously use a limit order, and this is what you guys should always be using, especially if you're trading anything with low liquidity, low volume. Make sure you use limit orders. Do not use anything besides limit orders for anything that has a very wide spread, that doesn't have a lot of volume, doesn't have a lot of liquidity, and that applies heavily to options. There's some stocks that don't have a lot of volume either, but for options, always stick to limit order, guys. Always stick to limit orders. Now, in this situation, if I want to buy 500 contracts, right, I would use limit and I would put in the price I want to buy it at. Now, since the spread is pretty tight, I'm not going to say, okay, well, I want to buy it for 257. I can say that I might get filled. I can say I want to buy for 258. I might get filled. But if I want to get filled 100% right now and have the highest probability, I hit ask at 259 and it'll most likely fill me. So just understanding the bid-ask spread is very important because when you guys go into trades, I want you guys to understand that what you're paying for the stock. Because a lot of time people might think, okay, if I buy 2 contracts or if I buy 2 shares, I am getting it for 259. When they look at their stock platform, they see that they've ended up paying 265, and they're like, "Whoa, what happened?" It's because you guys are using market orders. It's because you don't understand the bid and ask spread. So understanding that is very, very important for you guys to advance as successful traders.